And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And welcome to the show this morning. I'm your host, Lance Roberts. Of course, it is Monday as we start the last week of February. Already, second month of the year already past us. It's going to be Christmas before you know it. So, just saying. It's also my 60th birthday this year. So, yeah, you and me, we're getting up there. Exactly. I had this great idea over the weekend. So, my computer that I use at my house had difficulties, right? So I pay for premium support with this company, and because I need this computer I rely on. This is what I write newsletters on. It's what I do all my research on. So it's very critical that this thing works. So I pay for a premium support for this. So I can call somebody, have a dedicated line in India, and they're supposed to fix this, right? Well, their solution to fix my problem this weekend was I needed to reinstall Windows, which means I had to wipe my entire drive, start all over. I could barely understand the guy to get through all the instructions, but finally got there. So this gave me a great idea over the weekend. I'm starting a new business, and I'm going to create a help desk only in America, right? I'm going to charge $5. You subscribe to it. You pay $5, subscribe to it. It's monthly, right? But we'll fix anything, and it's somebody that speaks English. So just, you have trouble with anything, you just call this hotline. We'll chat GPT it for you real quick and tell you how to fix it. So, you know.
And there's only one answer.
Yes.
Reinstall Windows.
Exactly. My garbage disposal doesn't work. Yes, you'll need to reinstall that.
That would solve it.
That's the solution for everything. Yes, you'll need to buy a new one and have it installed. But it's under warranty. Doesn't matter.
We can fix anything.
We can fix it all. If I can't chat GPT it for a quick answer, it's the answer is always reinstall it. So anyway, my computer, after a very long weekend, is back up and running, and so I'm really tired today. So.
Are you running Windows on it?
Yeah. So, yeah. Anyway, it's all good. It's all good. We're back up and running, so it's all fine. All right. Speaking of that, I did get the newsletter out, fortunately, this weekend. And we went through a little bit, and I'll touch on this a bit more, but last Tuesday I talked about margin debt and the surge in margin debt that we're having. And I did some more analysis on that this weekend. Some very kind of shocking surprises that came out from that analysis, because margin debt has really just exploded here just recently. And again, that just kind of lines back up with this retail exuberance that we're seeing on a lot of different fronts, and particularly in the markets. And in fact, while retail has been very exuberant and willing to buy basically anything at any price, and I gave myself the hiccups, that is not what hedge funds have been doing. Hedge funds have actually been selling equity behind the scenes. And again, this is always kind of the case, is that when retail gets very exuberant about things, professionals tend to sell to them. And it's like, oh, you want to buy it? No problem. And what's interesting right now is, and this is one of the things, we've seen these companies like Toys R Us go bankrupt before. Other companies are going bankrupt. Hooters, the American icon that came out of Florida, is now about to file for bankruptcy. So, when Hooters is going bankrupt, there's a problem. But again, you look back at all this, it's all generally tied back to private equity. Toys R Us is a great example. Private equity company bought Toys R Us, loaded it up with debt, and then finally the company went bankrupt. Well, that's one of the things that's going on right now. We're probably going to see some more of this with companies in the near future. If a private equity company cannot get a company they own, which is privately owned, back into the public market through an IPO, because there's no appetite for it, which is actually happening right now. There's not a lot of IPO appetite at the moment. They do what's called a dividend. And that's where the company goes out and takes out senior debt on the company and then gives all the proceeds of the loan to the private equity company. So that's how the private equity company extracts the value from their business, by just loading it up with debt the company's taking on a loan to do nothing with it other than just give the money to the private equity firm. So again, we're probably going to see that a lot of that's been going on lately. There's been a big pickup in that. And so we're probably going to see a lot more bankruptcies in the near future, particularly as the economy begins to slow down, because those companies have taken on this debt not for productive purposes, strictly to just give money to the PE companies, is going to wind up showing up in the markets. But that's going to be something we'll just kind of pay attention to. But that's something you often see. Last time we saw that going on was in 2021, if that gives you any clue. So it's just kind of where you see peaks of markets. Here's what you need to know before the bell. On Friday, the market had a nice little sell-off here, about 1.7%, brought the market back to the 50-day moving average, and also triggered a MACD sell signal at the same time that we have, declining RSI. So the problem with this was, of course, on Friday we had two things that were going on. First, you had a decently large options expiration day, so that always increases market volatility. But right around midday, there was an announcement of another coronavirus outbreak in China. So that kind of sent shockwaves to the market, kind of PTSD, so to speak, from what happened in of course, 2020 with the previous COVID-19 pandemic. But that just led to selling in the markets. But that sell-off wasn't really surprising. We've talked about the fact that there's been a lot of retail chase into the markets as of late. Markets have been running up here, really just kind of ignoring all the news, whether it was in the inflation data, whether it was tariff risk, whatever it was like, no big deal, I'm buying stocks. And so we've just seen stocks really on a very kind of push higher, and any bad news that was coming along was simply just kind of ignored. And retail investors were just chasing stocks to higher and higher levels. And so the market did break out to all-time highs. But when you have the markets very extended on one side, and again, you had a lot of chase, money flows have been very strong into stocks, that sets the market up for a correction, but all you need is some type of catalyst. Well, on Friday, between that news on the virus and, of course, the options expiration, which was really the bigger issue for the markets on Friday, led to that kind of knee-jerk sell-off. Now, this morning, futures are pointing a little bit higher, up about 26 points on the S&P, so about 0.5% on the S&P. My suspicion is that this reflexive rally we're going to get this morning off the 50-day moving average probably doesn't hold. And so you want to try to use this opportunity here, use this bounce back towards the 20-day moving average around 604, and of course anywhere between here and recent highs. Rebalance risk in portfolios. Maybe think about raising a little bit of cash right now with this sell signal kind of back in place and money flows very high and starting to turn lower. We're starting to see kind of the early setup here for a little bit more correctional process. Again, not talking about a major sell-off by any stretch of the imagination, but we could see a period of sloppy trading here for the next couple of weeks, a pickup in volatility, and of course that's also going to be kind of that kind of trend that we see in early March anyway. So again, just kind of a seasonally weak period of the markets right now. Typically see a little bit lower prices. We could come down here and test the 100-day moving average at some point here over the next, couple of weeks or so. And again, sometimes this can take longer to happen. We were talking about this kind of very same thing in February of last year, and it took until early April before we saw that 5% correction. So again, it can kind of be prolonged and extended here, but we're starting to get kind of this early combination of signals that suggest a little bit of a sloppy trade in here as we start to go forward. The big news this week, of course, NVIDIA reports earnings this week. That'll be a big mover for the markets. That could weigh on the markets if those earnings don't come in as expected. Got a lot of economic news out this week. So again, there's just some risk here short term. So again, just think about reducing risk, rebalancing your portfolio a bit until we kind of get through this period and get markets back into a better technical setup for the next rally. That's what you need to know before the bell this morning. When we come back from the break, we'll pick up, talk a little bit about, kind of what's going on in the markets, but also kind of some things to expect as we start to look forward this week. And again, lots of stuff going on this week, lots of economic news. Don't go away. More of the Real Investment Show coming right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, a couple of things. First of all, if you are subscribed to my Substack channel at Lance Roberts on Substack, we're posting all of our stuff kind of in one place. Right now, stuff's kind of scattered out between the website and other stuff, so I'm trying to consolidate things at Substack, make it easier on you. We're going to start posting the Before the Bell video there as well. So you can now get the daily market commentary, the newsletter, blogs, and Before the Bell all in one place on Substack. So just if you follow me there, you'll get it all kind of tied up nice and tidy for you. And eventually we'll move the full show over there as well at some point. But again, that's a process we're waiting on Substack to figure that out. So we can stream live there. So that'll be one of the eventual migrations. So a couple of things. This morning, there's not a lot going on. We've got the Chicago Fed Activity Index this morning. Again, just that activity index is not really paid much attention to, but actually has 85 subcomponents to it. So it covers both manufacturing and services. It's a very broad index, and it actually is a good leading indicator of economic activity. And that has been showing some signs of weakness. So I'm anxious to kind of see that this morning to see if that data continues to show weakness. The Citi Economic Surprise Index has been declining. That's because economic data has not been coming in as strong as expected, a la the recent retail sales report was a lot weaker than expected. So again, there's some indicators that do suggest that the economy is slowing down. Last week, we saw the University of Michigan, the Consumer Confidence Index comes out. And it's very interesting because, again, this is a sentiment index. It's how do you feel about things. And if they were asking them like, well, how do you feel about your financial situation over the next year and over the next 5 years? Their financial outlook is terrible. It's been declining very sharply. They don't see any upside to their financial condition over the next 5 years or so. And then when asked about inflation, they're like, oh, yeah, inflation's going up. Well, what's interesting about that is that's all you hear in the media, right? All you hear in the media is how much inflation's going up, and it's eggs, and it's this, and it's that, and this other thing. So yeah, when you inundate people with inflationary headlines, don't worry about the economic data, what the economic data actually says. People are going to say, yeah, inflation's going up, because that's all they hear about. So again, you're gonna skew these sentiment indexes by what you put out in the media. And again, that's all they're seeing is every day on television, it's, inflation this, inflation that, and eggs and all this other stuff. So, the interesting part about that is also that it's a massive shift. Prior to the election, the Democrats didn't see when they interviewed them, they asked them what their political affiliation is. So people who identified as Democratic didn't see any real inflation. Those on the Republican camp saw inflation. And so there was this kind of a skew between what was going on. It's like inflation expectations were rising, but it was because of the survey balance of what was happening between the Republican and the Democrat answers to the questionnaire. Well, now that's completely flipped. So Republicans don't see any inflation. They see inflation declining. And Democrats are sure that inflation is going to come surging back. So it's very interesting. There's a big political dynamic to the inflation expectations since the election, and really kind of before the election and then after the election. Because remember, before the election, it was all about Joe Biden and the Inflation Reduction Act. So, depending on who you're supporting, that was kind of your view. So it's interesting when you take a look at inflation expectations, there's two skews to that. One is that's all that people see in the media. And then two, there's a big political component to those inflation expectations. So again, how does that work out in reality? We'll see. But again, you have to take inflation expectations with a grain of salt. But I will say this about inflation expectations. They do feed into what's called the term premium. And we've talked about term premium on the show before with Michael Leibowitz, but term premium is just the difference between where inflation and interest rates, where interest rates should trade based on the fundamentals and where they are trading based on sentiment. So the term premium is nothing but the sentiment between the value of interest rates based on fundamentals and where interest rates are currently trading. And so a lot of that inflation expectation kind of feeds into that. That's a very volatile number, by the way, inflation expectations that can change on a dime. But again, it's just kind of an interesting dynamic when you look at it because it's all psychological. It has nothing to do with reality. It's just simply how people feel about certain things because of what they hear on the news, or in this case, in particular, a big political bent of, well, I don't like the president, so I think it's inflationary, right? So, you got to really kind of take that with a grain of salt and always kind of, when it comes back to inflation, interest rates, come back and look at the fundamentals. What drives inflation, of course, is economic activity. And we're starting to see a whole lot more of the economic data starting to come in and suggest that economic growth is actually slowing down a good bit more than what kind of some of these lagging headlines suggest. And so we'll see if that kind of plays catch up. Later this week, we've got GDP. It's the second revision to the fourth quarter GDP. So remember, when we do GDP, we have this first announcement of GDP, then that first kind of estimate. So we saw the initial estimate of GDP that came in at 2.3%. That's solely based on kind of economist estimates. So what the government does is they just kind of survey all the economists out there that are on their kind of list, and they go, what do you think it is? And they all go, well, I think it's 2.3, because they don't have any data yet. And then as data starts coming in, then they start actually calculating what the fourth quarter GDP was. So now we're in end of March, so we've got we're in the end of February, so we've got January's data. That retail sales report is a good example. Will be in now this new data that they're calculating for GDP. Now we'll do a third estimate of this in March, so we'll have 2 months worth of data to look at and say, okay, well, that's where GDP was in the fourth quarter. So we'll have kind of all this data coming in that they can now use to actually calculate GDP, which I suspect is going to be a little bit less than 2.3, maybe closer to 2% growth in the fourth quarter. And then, of course, in a year, we'll come back and revise GDP entirely. So, and this is always the fascinating thing. So when you talk about GDP, we do 3 revisions, then we do an annual revision, then we do another revision in 3 years. So we're constantly revising the GDP data. China, 15 days after the end of the quarter, they come out and say, that's GDP. They never revise it ever again. That was it. So you always have to kind of take China's GDP numbers with a grain of salt because it's pretty much just state propaganda. That's our GDP growth. But, if you've got a full, they are so good at economic forecasting. In 15 days after the end of the quarter, they have all the data. And they know exactly what GDP was to the penny and then never revise it again. So again, just, kind of always take that a little bit. When they say what GDP is in China, just go, yeah, sure. We got you. Yes, that's what it is, or else. You believe it and you like it. So anyway. I'm just gonna leave that alone right there. It just reminds me of the old Hitler knock-knock joke. Exactly. It's all coming. Anyway. So anyway, we have a lot of data coming out this week. That's obviously on Friday is the PCE inflation report. And of course, that is the one report that the Federal Reserve pays attention to. So while the market pays attention to CPI, like that has any impact really on what the Fed does, it's really personal consumption, expenditure, inflation. That comes out on Friday. That's going to be the big driver for both the bond market and the stock market on Friday. That's expected right now to come in at 0.3%, which was also previously at 0.3%. So no change from last month, but again, a 0.3% increase. Inflation year over year is expected to be 2.5%. On the PCE front, that's lower than the 2.6% last month. And the core PCE month over month is expected to be at 0.3, with the core PCE year over year at 2.6, down from 2.8 previously. So again, they're expecting a little bit weaker PCE report. And again, this is the one report. It's not PPI, it's not CPI. Yes, the Fed pays attention to that, but it's really PCE. And in particular, the Fed pays what the Fed looks at in terms of their monetary policy is what's called the trimmed mean PCE. So it strips out the highs and the lows and looks at the mean estimate of what's happening with PCE. So again, that's what they actually look at in terms of monetary policy. So this will be a big report on Friday in relation to both where interest rates are, where the market is, et cetera. So again, all this is going to kind of build up this week. We've got NVIDIA earnings, I think, on Wednesday or Thursday. And then on Friday, you've got this PCE report. So a lot of data kind of driving markets this week. And again, I would certainly expect a bit more volatility, particularly after Friday, and particularly given all the data we've got coming up this week, there's some real risk that we may see a little bit more market turmoil. So that's what I was saying earlier. Just be a little bit cautious right now about your positioning and exposure. You might want to just just look at maybe raising a little bit of cash, just reduce any risk that you've got that's really hanging out there. Again, I have no idea how this week's going to play out. But there's a good setup right now for a little bit more volatility as we get through this week. All right, quick break. We'll come back, talk a little bit about margin debt. I told you I did a little bit more work this weekend in the newsletter. I'll show you a couple of charts on kind of what's going on with margin debt and why it's at least worth paying attention to. It's not a reason to be concerned, but something to definitely pay attention to. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your question about Social Security benefits and what the
removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So today's earnings announcements are making me hungry. We have Cheesecake Factory, followed by Wingstop and toast. I've got a craving for toast and wings right now, and
Toast
some cheesecake.
and wings.
Toast, wings, and cheesecake.
The Real Investment Show podcast.
What diet are you on right now?
Don't eat anything and work out like a fiend. So
Yeah, how's that working out?
It's working out great.
Oh, you
I've
sure?
lost 4 more pounds, so I'm down.
That's it?
At realinvestmentadvice.com.
I didn't have that much to lose to start with.
I don't know.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. So, interesting comment in the chat this morning, which is, will markets ever return to a time when we didn't focus constantly on, kind of the next day data, right? So just this really short-term focus on markets and just kind of migrating from one economic report to the next, one earnings report to the next, whatever it is. And that answer is no. Unfortunately, we won't. And this has part, and again, I told you I was going to just touch on what's going on with margin debt. And again, this kind of plays right along with that, is that, there's been changes to the markets from when I first started in the markets back in the, the early 80s late 80s. And when I was growing up, I remember Mr. Lehman, he lived about 3 doors down from my house, and he was the quote unquote the rich guy on the street, right? And so I grew up in this small town where there's about 20,000 people in the town. It's a chemical town. Everybody in the whole town worked for Dow Chemical, and so everybody kind of knew everybody, right? Because everybody all worked together for the most part. And so there was Mr. Lehman, who lived down the street. He was the guy that had a stockbroker, and you'd see him walk down to the end of his driveway in the morning and get his copy of the Wall Street Journal, and he had a stockbroker, and he was investing in the markets and all that. And that was really something in a blue collar town, in particular, you didn't see a lot of at that time, right? That just wasn't something that everybody did. And in fact, I remember growing up, it used to be, fathers would tell their daughters, honey, when you grow up, marry a doctor, a lawyer, or a stockbroker. That was if you could do one of those three things, you were going to be in pretty good shape. That was the thesis back then. But back then, the only way that you got data on the market was pretty much through the Wall Street Journal, right? Or the New York Times, or whatever, paper you were getting. But primarily is if you were investing, you had a subscription to the Wall Street Journal. And you get the Wall Street Journal, and I would go down to Mr. Lehman. His son, David, was my best friend growing up. So I was always down at their house. We were always playing, doing stuff, playing sports, whatever. And he would be sitting at the kitchen table and, with his cup of coffee, and I would go over there, and Dave and I'd be hanging out, and he'd be reading the Wall Street Journal and then going through and circling data in the Wall Street Journal. So I would go talk to him and say, well, what are you doing? And that was really where I got my introduction to financial markets and investing, is he would explain, this is a company that I own, here's the price changes, and pretty much just explaining, how to read the Wall Street Journal. And it was this cryptic thing at the time when you would look at the Wall Street Journal. It's just, hey, you had articles, but you had just pages of data to look at. And, so you had to really understand what you were looking at, the highs, the lows, the intraday changes, and he would plot it. And he was also the one that taught me the very basics of, really starting to understand charting, right? And just picking, at this stuff. And so anyway, it was really interesting. But that was a rarity, and you wouldn't see that very often with people, and especially in a blue-collar town. That was just something that didn't happen. But you would be looking at data, and this was stuff that happened 3 days ago, right? So, GE would report earnings, and 3 days later, it would show up in the Wall Street Journal. And so there was this big lag between an economic report or an earnings report, and by the time somebody saw it in the Wall Street Journal, and then they had to call their broker. And, when I first started working in the financial industry, that was back in the day, we had vacuum tubes. So you'd have to write the order out, put it in a vacuum tube, and it would go over to, the trading department, and then we get, that trade we could execute. So there was this huge lag in the way the whole system worked. And that was actually a good thing, right? Because it slowed everything down. So yeah, GE came out, they missed earnings by a penny, right? But it's 3 days later now since they've reported earnings. That news is, it's like, okay, they missed by a penny, but, you read the article about their earnings report and it says, no, but their outlook is strong, their business is still good. It's like, okay, so they missed by a penny, who cares, right? Nobody went out and wasn't this knee-jerk reaction to just selling everything just because they missed by a penny. It didn't happen then. And also, too, at that point, and I was like, I read the article and it's like, oh, GE misses earnings by a penny. So you'd have to call your broker, get on the phone with a broker, and the broker's like, look, just calm down. You don't need to go sell all your shares. This is what they said. Here's what is going on with the stock, blah, blah, blah. And you'd have this conversation with your broker. And, maybe you'll sell some, maybe you'll buy some, whatever it is, right? But it was a much slower process. And what that led to was much longer holding periods for stocks by individuals. The average holding period back in the 70s, 80s, really even early 90s was almost 6 years to own a stock. So if you're holding a stock for 6 years, a quarterly earnings announcement or an economic report, whatever it was, it really didn't mean a whole lot. So things just moved at a much slower pace. Investors were better off. They wound up making more money over time. But then we started migrating towards this environment that we have today where it's this instantaneous explosion of information. And when the internet first came up online, so in kind of the mid 90s, when the internet first came really kind of fruition, it was a fad. Internet wasn't going to stick around. Everybody knew that. There was a rule passed that when a company made an announcement, it had to be distributed to everybody at the same time. And so everybody gets the information all at the same time. And so, of course, with the speed of the internet now, we're getting all this information real time. And so as markets became more and more automated, and we moved from fractional share trading in terms of, we used to trade stocks on fractions. So you'd buy a stock at 28 1/8, 28 1/4, 28 1/2. Then we went to decimalization, which allowed us to have much smaller spreads between stocks. And the information explosion of just getting more information real time led to investors making more brash decisions. And then we took it one step further, and then we just gave investors the ability to trade their own portfolio, and they didn't have to go through another party at that point. I didn't have to call a stockbroker anymore. I could just trade online. And then this is just has exploded to this real-time trading environment where the average holding time is now down to about 4 months for stocks. So we went from 6 years of holding down to 4 months, and this is because of this access to information, this ability to trade at a whim, and really no break on that environment. And so, this idea that will we ever go back, get away from the short-termism and go back to an environment where we're actually just analyzing the fundamentals? No, that's never going to happen anymore, because we have created an environment where we have turned the markets from investing to grow our savings to outpace inflation over time and maintain our purchasing power parity to a casino where we're all just betting on what's going to happen next. So literally every day, it is just a bet on what the economic news is going to deliver. And we may start out this morning with the markets up 20 points, 26 points. On the S&P Dow right now is looking to open about 300 points higher this morning. That could be all gone within 20 minutes if a headline comes out or if something changes, because we're just making these very rapid bets on the overall market. And this makes it very difficult for investors to buy and hold over time. And this is, and unfortunately, this is why investors repeatedly, buy tops, they sell bottoms, because they're being driven by what's happening in the news. And this is why you've got to be very careful about the news that you absorb and looking at the headlines, so to speak, because again, that all feeds into your emotional bias. So, one way to get views and clicks is to give you a really bearish headline. This morning's headline, Margin Debt says markets are going to crash, right? Y'all would all watch this video, right? The problem with that is now you start making an assumption about that. A good example of that, this weekend I did a podcast with Adam Taggart on Thoughtful Money. And I was just talking about earnings expectations are way too high. And so the headline that he posted was basically markets are going to crash because earnings expectations are way too high. So I got a lot of really kind of nasty comments from people about that. And I could tell from the comments, they didn't even watch the video. All they did was just look at the title. They didn't watch the video to where I explained, hey, earnings estimates are high, those are going to have to come down. That doesn't mean the market's going to crash at all. It just means that, we're overpaying right now for earnings, and earnings are going to be lower, so we need to accommodate that into our outlook about what we're actually paying for stocks. That was the conversation. The headline generated all kinds of panic by people going, well, why didn't you tell us the market's going to crash? Well, because I didn't say that, but the headline drives that emotional bias. Now, what does this have to all do with margin debt? Well, I'll come back after the break and I'll tell you. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year. What are you going to do with all that extra income? Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets. Saturday, March 29th, Richard Rosso and Danny Ratliff answer your question about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, just for the break, I got this question about this whole short-termism of the market. Will we ever go back to the days where markets were more normal, I should say? And the answer is no, we're not. And unfortunately, this is just the market that we're in now. We've turned markets into a casino, and so we have to play that game, so to speak. But I will warn you that if you treat the markets like a casino, they will treat you like a casino, and the house always wins. So you have to be careful how you play the game. And this is where, there's a difference in Vegas. The vast majority of people that go to Vegas lose money, even though they tell you they win. Everybody you ever talk to that goes to Vegas, they always win, right? They're lying. They lose because otherwise you wouldn't have these massive buildings and casinos and free buffets in Vegas if they weren't making money, right? So just keep that in mind. They're making money off the majority of people that show up there. But there are professionals that go to Vegas and they can win enough to make a living. And some of them make a very good living doing that. But they know the rules and they know when to hold, when to fold, when to walk away, when to run, to quote an old Kenny Rogers line, right? And that's very important. The same thing in the financial markets these days because of the speed of information, because of how we, treat markets these days more like a casino than we do an investment strategy. You've got to be more adept at knowing when to hold them, when to fold them, when to walk away, when to run, right? And there are some signs right now that we may want to be a bit more cautious. Margin debt is one of those. But as I explained back on Tuesday of last week, I wrote an article, touched on margin debt a little bit. Margin debt is when people are borrowing capital against their portfolio to invest in more stuff. So, for instance, if I own $100,000 worth of Apple shares, I can borrow 50% of that value and buy more stock with it. So I can take a $100,000 portfolio, turn it to a $150,000 portfolio of Apple through margin. Now I'm paying an interest rate on that margin line, just like a regular debt, but I have buying power on margin. When people get very greedy about markets, it becomes a very tempting bet to borrow against my account to buy more stuff because, man, just everything's going up and I want to own more of that, whatever it is that's going up, and I don't have any more capital to invest, so why not just borrow some, right? It makes complete sense, right? This is a chart of consumer confidence about higher stock prices versus margin debt and the year-over-year rate of change in margin debt. The red shaded area, and if you're driving, please don't try to look at the chart. I'll explain it to you, but there's a red shaded area in the background, which is the highest level on record right now, and that's consumer confidence about higher stock prices. Consumers are very confident about higher stock prices over the next 12 months. Markets are just going to go up from here. So if that's the case, why not? And that's why there's a very high correlation between the rate of change in margin debt versus confidence. If I'm really confident, I'm going to take out more margin. And right now we've got a very sharp increase in margin debt on the year-over-year rate of change. And we're at levels that have been close, not every time again, but been close to areas where markets typically tend to start struggling a bit. All right, you kind of got peak exuberance, peak everything going on with the market. And so we kind of see that same thing if we look at the rate of change from the 12-month low in margin debt. So the last time we had a 12-month low in margin debt was in 2022, right? We kind of wiped out margin debt through the whole sell-off in the market. We've had a very sharp increase over the last 2 years in margin debt from that 12-month low. Now, we're not at levels that we've seen previously, and so we can certainly go more from here. And that's kind of the important takeaway from this is that we're seeing early evidence of kind of that irrational exuberance of investors in markets, but it can certainly go a whole lot further. And so whenever I talk about this, I always get comments from the kind of the reading public or whatever. It's like, well, this isn't as high as it was last time, or, this time is not, the same, this time is different, whatever. There's always a good excuse for why this time is different. And so we can look at kind of different measures of this. And one thing we can do is look at kind of the momentum of the markets. And so we can apply some kind of basic technical analysis to margin debt to understand the momentum change in that. And so using a stochastic indicator, we can see that on a momentum basis, we are back near levels that have been very coincident with previous market peaks. Now, again, this doesn't mean, let me be really clear here, right? This does not mean the markets are going to crash at all. That's not what this means. It just means that the speed of increase in which investors are taking on margin debt has accelerated sharply. And again, that's buying power for the markets. That means it's like, well, markets keep going up. Well, yeah, because margin debt is buying power for the market. I can take out debt and buy more stuff, right? Why do prices go up? Supply and demand. There's too much money chasing too few assets, driving prices higher. And so, they're taking out margin debt not to just buy. This isn't just about stocks, by the way. This is margin debt to go buy more Bitcoin, to buy more gold, to buy more stocks, to buy more whatever, emerging markets, international markets, you name it, right? If it is a equity kind of proxy for the market in general, margin debt money is flowing into those areas, and that's providing this additional buying power. And for the naysayers of margin debt, they're absolutely right. Margin debt provides buying power for the markets. Absolutely true. The reason that we pay attention to margin debt is because it is also the fuel for a correction. Because margin debt provides buying power on the way up, but margin debt also provides selling power on the way down. And what do I mean by that? The problem with margin debt is that you are not at your discretion of when you pay it off. When the market begins to correct, you have what's called a margin limit on your portfolio. And when, again, so using our example earlier, $100,000 worth of Apple, I can borrow 50% of Apple to go buy more stock or whatever I want to buy with. I can go 50% of Apple and buy gold with it. I can buy whatever's going up, right? Well, the problem is that 50% margin line is the maximum. So when the value of the account falls from $100,000 to $80,000 in Apple, I'm only able to borrow $40,000. So I've got 50 out. I can only borrow 40. So now I've got to come up with that $10,000 difference in the portfolio. And that's not at my discretion. You don't have a couple of weeks to do that. Like you don't get a call, hi, this is Schwab, and I'd like to tell you that you have a margin call on your account, and if you wouldn't mind, I need you to stick in another 10 grand, but it's okay, take your time. Anytime in the next month, if you can just throw an extra 10 grand in there, it'll be fine. No, that's not the way it works. You get a call from Schwab, and they say, you've got a margin call, you have until close of business to either deposit $10,000 or more assets, or liquidate your portfolio down to where your margin balances are back in line. That's what's called a margin call. Margin calls create selling. And the problem with the margin call is, here's the problem. I have $100,000 worth of Apple, as I explained to you last week. I have a 50% margin line on it. Apple falls to 80. I've got to sell some assets in order to shore up that 10,000, but I just sold $10,000 worth of my Apple to shore up that 10,000, which means now I've got 70, which means I now have 35,000 margin line, and it just starts feeding on itself. So then any incremental decline in Apple just fuels this forced sell-off in the markets, because margin debt is not at your discretion to cover it. When those margin calls come, they just keep coming. And people that typically run a lot of margin during a market decline, they get wiped out because those margin calls just keep coming and just keeps forcing them to sell as the market goes down. And again, if you've got a lot of margin debt in the markets like we do right now, that just fuels the sell-off in the market. And that's what creates a larger decline. So again, I don't want you to leave this conversation saying Lance said the market's about to crash because of margin debt. No, that is the fuel. As long as nobody throws a match on the pile of logs that have gasoline poured all over them, it's fine, right? I can have a whole pile of logs, throw gasoline all over them. It's completely fine until somebody throws a match on it. Then you got to fire. That's what margin debt is. It's just fuel for a sell-off. You need a catalyst of some sort to cause that to occur. We don't have the catalyst right now, but this is worth being aware of because it is the fuel that provides the potential for a larger sell-off that can come very quickly. This is how you can get a 5 or 10, 15% correction in the markets or more very, very quickly when you have this much fuel kind of all piled up in the market at one time. It just needs the right catalyst. Now, whatever that catalyst is, we have no idea. We'll see. But it's just something to be aware of and something to watch pretty closely, at least right now. All right, that wraps up the show for the day. All those graphs and charts in the weekend newsletter on the website right now, realinvestmentadvice.com. Be sure and like and subscribe to the channel. We appreciate you. And we'll be back tomorrow with John Penn. Get back into the markets. We'll see what happens today. And we'll go from there. So y'all have a great day. See you then.